Hello, everyone, and welcome to today's webinar, Long-Term Care, It's About a Plan. I'm Kevin Skippington, and I'm the Manager of Wealth and Participant Education at SRP. It's great to see so many of you today joining us, including a lot of familiar names from previous sessions. As a reminder, we host these webinars quarterly, and the topics are driven by feedback and questions we hear directly from employees like you who participate in the retirement plans that we support. A few quick notes, all lines are muted. If you have a question, simply scan the QR code that'll be on the right side of the presentation slides labeled Ask a Question. We'll get to as many of these questions as time allows at the end of the session. If at any point you'd like to request a one-on-one consultation for further information, scan the QR code on the bottom left of your screen. Your advisor from the SRP team will follow up with you after today's session to get something scheduled. This session is being recorded, and we'll share the recording with all who registered for the webinar and post it on our YouTube page by next week. Now, I am very excited to introduce today's speaker, Brian Langdon, who is the National Spokesperson for Long-Term Care and Disability Income for Ash Brokerage, one of SRP's trusted insurance partners. Brian brings passion and experience to this topic, along with a very clear mission: help protect individuals and their families through thoughtful planning. Today, he'll be sharing the story of the powerful impact that long-term care planning can create and how that can bring value to your life. Brian, the floor is yours.
Thank you, Kevin. Good afternoon, everybody. Today's discussion is long-term care. It's about a plan. And I usually like to emphasize to people that long-term care, the thought about long-term care and where long-term care fits within someone's retirement plan is truly it. It's about a plan. It's not necessarily about buying insurance or buying a product, but it's a thoughtful discussion amongst yourself and your family about how you would like to receive your care. Hopefully it never happens, but if it does, where you would receive it, how you would pay for it, how it would fit within your retirement plan and your family's plan for you. Because when a long-term care event happens, there's no doubt about it, it does become a family issue. So we mentioned a little bit earlier that you do have the QR code to ask some questions that we'll answer here at the end of the discussion. So we're going to talk a little bit about what long-term care is. We're going to define it for you. We're going to talk about why planning is important. We're going to talk and touch on Medicare and Medicaid. Certainly, you want to understand the government programs that are available for long-term care as you decide to create your own plan. And then at the end of the discussion, we're going to talk about private long-term care options. Now, we're not going to talk about a particular company or a particular product. That's not how this planning process works. You want to understand what your needs are, what your concerns are, and if you decide to look at an insurance option, then we're going to go back and then find the right option that makes sense for you. So let's get started. Let's talk about what long-term care is. Well, long-term care is help with activities of daily living. And you're going to hear this term, activities of daily living, shortened often to ADLs. And then activity of daily living is eating, bathing, toileting, continence, transferring, or dressing. But it's the normal activity that you might do in your home as we age in place. Long-term care is often assisted living. It's custodial care, helping you remain in place as we age in place. It could often be home care or adult daycare. Years ago, in fact, when I was in high school, I came home from school one day to find my father there, who gathered my brothers and I together to ask us to move our furniture out of our living room. Someone into the dining room, someone into the garage. And after we did so, my youngest brother asked what was going on. We were, as a family, going to bring my grandmother home to live in our house. She needed care. My parents didn't want to send her to a nursing home, but that was my idea of what long-term care was years ago. It was either in a home with loved ones or it was in a nursing home. What you're going to find out today is that there's so many different ways for families to deal with a long-term care event. There are different places to receive your care, different ways to get it, to find it. And it's also very important for people to understand the environment that they want to be in. Long-term care is not just skilled care. Now, we're going to find out when we talk a little bit about Medicare that Medicare focuses on skilled care, but skilled care only. And again, long-term care is not just nursing home. In fact, I often will tell people that if you do proper planning earlier in life and actually set forth a plan that is both comprehensive and legitimate, the odds of ending up in a nursing home actually are pretty small. The reason is you've made provisions behind earlier in life to do home care or maybe even assisted living. So let's talk a little bit about why planning is important. Well, we're living longer, and that certainly impacts all of us as we begin to think about entering the retirement phase. You know, we don't pass now in our late 60s or early 70s. Lots of us hopefully will live into our 80s or maybe even to our 90s. And you can see the fact that the average life expectancy is longer means that we have a greater risk that at some point in time we may slow down. Here's something else to consider, and I'm going to get into that in a little bit more detail in a moment. But the fact is, not only are we living longer, but there's more of us out there, right? The baby boom generation is finally retiring and retiring in large numbers. So when you think about long-term care and you think, well, there's going to be a lot more people out there with the need for long-term care and they're living longer, that double whammy really is going to put pressure on our care delivery system here in the United States. We're going to have more people with a greater need for a longer period of time. That means that our nursing home rooms, our assisted living facility units, our home care workers are going to be stretched thin. That then is going to mean that we're going to have an impact on care. So think about care and extended care where we are today. Now, one of the things that I often point out in this particular slide is the fact that the home care number is based on 44 hours a week. So you look at that particular number and $50,000 is a lot of money, but think about doubling that to 88 hours a week, which would mean 10 and a half hours a day. So if you want to bring your loved one at home and make sure that you're able to take care of them and that they can stay in that environment, you might be looking at a six-figure need over a period of time. But here's the important thing about this particular slide. Extended care is expensive today, but for those of us on our discussion today, we're probably not thinking about care tomorrow, next week, next month, maybe even next year. We might be thinking 10, 15, 20 years from now in the process. So where is long-term care going to go over that period of time? Well, if long-term care costs go up at just 5% a year, that means they're going to double in 15 years. Some studies are saying that during COVID and post-COVID, that long-term care costs not only jumped up at 5%, but in some cases for assisted living and nursing home and home care, they jumped up at 7% and even 10% over a number of years. Now, I work for an organization called Ash Brokerage. We are the largest distributor of long-term care insurance products in the country, but we're based out of Fort Wayne, Indiana. I have a particular close relationship with an assisted living facility in town because I had a loved one that was in the assisted living for a number of years. And as I go back to visit that facility and check in and see how they're doing, they used to tell me year after year, you know, Brian, we always try to prepare families that long-term care costs here are going to go up at least 5% a year. But during COVID and post-COVID, their costs now are up 10% a year. I hear that as I go around the country and discuss long-term care. So you got to go back to an earlier slide when we talked about longevity and the number of baby boomers that will be requiring services. We live in a demand economy, and when supply doesn't keep up with demand, we know what that does to cost over a period of time. So we like to say to folks, understand what a long-term care event might cost you over a period of time, and do understand that just a short 3-year stay, as you see in front of you, could cost you quite a bit of money. Now, Does that mean that you have to save or set aside every dollar for this potential stay? No, it does not. But what we want people to understand, that if you do live longer and you do slow down in that process, you may have an expense that you don't and haven't planned for in your retirement process. So this is directed at our business owners out there. A very long time ago, almost 20 years ago, the federal government passed a tax law that included some very advantageous tax deductions for business owners with long-term care. Now, it depends on how you're incorporated, whether you're a partnership, LLC, S Corp, or maybe even a C Corp. But what the government allows for long-term care premiums is that as that business owner, you could have the business pay the premium for you, a spouse, for a key employee. That long-term care premium would be tax deductible to the business as a business expense. And the business and the benefits, when you might need them later in life, maybe when you're in retirement, are going to be completely income tax free. Now, I have a lot of people ask me, well, why in the world would the government do this? Well, what you're going to see when we talk about Medicaid is the largest payer of nursing home beds in the country. The federal government and our state governments would prefer that people take personal responsibility when it comes to long-term care cost, future costs for long-term care, because they don't want the Medicaid system to be stretched or maybe even damaged when all the baby boomers are in a situation where they're going to need a need. So if you are a business owner out there listening this today, and you follow up after today's discussion, make sure you ask specifically about how I can learn more about paying the premium through my business and taking it as a tax deduction to create income tax-free benefits. So let's talk a little bit about what your plan is. Now, some really basic questions when I talk to people about creating a long-term care plan. I'll ask them like, how do you feel if you're going to live a long life? Now, sometimes people will say to me, oh, all my relatives pass at an early age, and, I'm not sure that I need to think about living past 65 or 70. And I always am reminded of my mother and my father. On my father's side, my grandparents live into their 90s. Their brothers and sisters all lived into their 90s, but my father passed away at 67. In my mother's case, both of her parents died in their late 50s. My mother lived to 84. We don't always know exactly how long we're going to live, but we do know this: modern medicine is better. If we go to the doctor, we follow the instructions, if we take the meds that were prescribed, if we try to live a healthier life, the odds are greater that we are going to live a longer life. Do you agree that the longer you live, the greater likelihood your health could become compromised and you may need some kind of extended care? Of course you do. In that period of time, we're still sharp. We still understand what's going on. We're still engaged with people around us, but we begin to slow down, and sometimes slow down greatly in the process. Well, most of us would prefer to remain in our home, but we need help. That's where long-term care planning comes in. But if you needed care, would that have an impact on those you love? Of course it would. I tell people all the time, when you have a long-term care event, whether you like it or not, it becomes a family event. Often I get called into scenarios to consult in a case where no planning has been done whatsoever. And so maybe there was a stroke on a Tuesday, got rushed to the hospital, and the following Tuesday or Wednesday, the wife has to bring the husband home, and all of a sudden now you have to think about, do we need to bring caregivers in? How often do we need caregivers come in? How often is the wife or the husband, how are they going to be able to sleep at night? Where are the kids? How do they get involved? I often laugh because I see scenarios, especially when you have families spread out all over the United States, when parents age in place, they look up, or the kids look up one day and they find their parents are in their 80s and they've slowed down, they need some help. And now who helps in the process? I hate to tell you, the cliches are true. It happens usually to be the daughter, the oldest, who's thrust the checkbook without any planning and said, here, you help make it work. But what that does in a time of extreme stress to the family puts families in a situation where they're often at odds about how to take care of their loved one. Are they doing it right? Are they doing it enough? Is this too much? Is this too less? Are you spending the right amount of dollars in the process? All stressful questions that happen to families. And unfortunately, I tend to find out that families don't necessarily all get on the same page. I had a colleague here in our office not too long ago came to me and said, hey, my parents are trying to deal with my grandmother. She has a very small long-term care policy. We're trying to figure it out. Would you help us as a family? And I said, yeah, I'm happy to. So I did a conference call one evening. Parents, aunts and uncles, some nieces and nephew, we all got on the same call. But my first question was this: is everybody on the same page? Because I find it often that families don't get on the same page when it comes to taking care of a loved one. So you have a high stress situation. You have to try to figure out how to try to pay for it. You have to do everything on a fly. And I gotta tell you, a lot of times it doesn't work out well for the family. So understand that when you're thinking about where long-term care fits within your retirement thought process and your retirement planning, that long-term care can put enormous stress on that family without some proper prior planning. So let's talk a little bit about what the government will pay and the government won't pay in the process. So Medicare, which is the federal program that most people will get at age 65, does have a skilled care benefit built into the Medicare plan. Remember, we talked right at the very beginning of our discussion today about skilled care and custodial care and what the differences are. Medicare will only do skilled care after a required 3-day hospital stay. And by the way, Medicare won't count your intake day, so it's actually 4 nights in the hospital before Medicare will even think about reimbursing for skilled care. And as you can see, for the first 20 days, Medicare pays 100%. Days 21 through 100, you have a co-insurance that's often picked up by your Medicare supplement, but Medicare stops on day 101. In fact, last year, an advisor that our organization had worked with for a number of years called me out of the blue and said, you're never going to believe where I am. I said, well, I don't know, so you're going to have to tell me. He said, I'm in a Medicare skilled facility. They just left. I'm on day 96. They told me by this Friday I have to get out because my Medicare days are going to run out. I need to get my long-term care policy started. Well, we probably should have started that process a little bit earlier, but the stress in the voice for not only him, but his spouse and their children we got to do this very quick. We got to figure out where we're going to take dad. We got to figure out the environment in the process, made it very difficult. So what I try to get people to understand is that there is a limited benefit within Medicare, but 100 days is not long-term care. More and more, I get the question of, Brian, hey, do you see Medicare expanding benefits for long-term care? And the truth of the matter is, I do not. I don't see in today's environment, with where we are with budget deficits, that Medicare would greatly expand its long-term care benefit. Now, Medicaid is the state-run program. Now, it's funded mostly by the federal government, but it's run by state. And that's our social safety net. But there's some things you have to do in order to qualify for Medicaid. First, you have to spend down your assets to about $3,000. So That includes everything, including those of you out there who have large 401k balances or IRAs. That's a qualified asset that must be spent down in order to qualify for Medicaid. You can see that in bullet point number 2. Qualified funds are accountable assets. They must be spent in order on your behalf to qualify for Medicaid. You're going to agree to income limits, and it's subject to bed availability. Now, some states are beginning to expand and explore providing some home care for Medicaid recipients. But the truth of the matter is it's not 24/7. It's not 18, 20 hours a day in the process. It's a limited benefit in the process. So does that mean you could be sent to a different community if you qualify for Medicaid and you're looking for a bed available? Of course you could. In fact, in my own family, a younger brother who had a long bout with a brain tumor found himself in a situation where he was impoverished, applied for Medicaid, was sent 70 miles away to the first bed that was available in the immediate vicinity of his community. Also, when qualifying for Medicaid, there's a 5-year look back on asset transfer. That means that when you go to the state to start the process of trying to apply for Medicaid, the first thing they're going to do is take a look at every transaction, every savings, every expenditure you've had over that 5-year period of time to determine whether or not that was done on your behalf. And finally, assets can still be recovered even after death through the Estate Recovery Act. Just last week here in Indiana, I had the newspaper reading a story about a family that was dealing with the state that was going after the sale of a home after the death of the second spouse, trying to replenish the Medicaid coffers for the next generation of need. Now, the family was surprised that the state could go for the proceeds from the sale of the house in the process after the parents were gone. It created enormous hardship, not only for the family, a lot of stress for the family, and they were trying to fight it tooth and nail, but unfortunately were unable to do so. Now, we talked a little bit about longevity, the number of baby boomers, how that's going to impact the future cost of care when it comes to long-term care. We've talked about how Medicare is going to provide about 100 days of care for skilled services, not custodial. And we've talked about how Medicaid is our social safety net that you have to qualify for in the process. So we're going to make a transition, and over the next few minutes as we wrap up our discussion today, I'm going to talk to you about private long-term care insurance options. But here's the key. I'm not going to talk about a company, not going to talk about a particular plan, because long-term care solutions are not a one-size-fits-all process. It's just not. Everybody has different needs. Everybody has different concerns. Everybody might pay for their long-term care insurance in a different way in the process. And so I encourage all of you out there, if you're kind of on the edge of your seat saying, okay, well, I want to understand how these insurance products work. Understand that when we're done today, that you want to reach out to your advisor and find out what works for you. Because I can almost assure you that your need will be different than your neighbor's, different than somebody across the street, somebody down at church, somebody at a club in the process. I never see the same solution blanket the entire population. It doesn't work that way. A couple things to understand about long-term care options are all qualified long-term care insurance plan benefits are income tax-free. That's right. You may collect a couple $1 million of long-term care benefits and not pay any income tax whatsoever. And you're able to collect long-term care benefits one of two ways. Either you can't perform 2 of 6 of your ADLs, there's that term again, activities of daily living, ADLs, eating, bathing, toileting, continence, transferring, or dressing. So if you can't do 2 of 6 ADLs, or you have a severe cognitive impairment, and that condition is certified to go at least 90 days, then you qualify for your long-term care benefits on all of the options that we're going to touch on here in just a moment. So again, long-term care benefits are income tax-free. You collect one of two ways. Either you can't perform 2 of 6 ADLs, or you have a severe cognitive impairment. And in both cases, a medical professional must certify that your condition will go at least 90 days. And by the way, that almost always is your physician. So there are roughly 4 different types of long-term care insurance. The first that we call standalone or traditional, it's pure insurance. It's been around the longest. The second is a linked benefit life hybrid, which is we combine life insurance and long-term care. In part, this solution came about because some people were saying, well, if I buy the first standalone, that traditional long-term care, and I pay for premiums for 30 years and never use it, do I get any of my money back? So the industry got together and said, well, let's kind of put some hybrids together so that people, if they choose to, pay a little bit more, but then be in a situation where the money will come back to them or their heirs. Third, we also have a linked benefit annuity hybrid. The interesting thing about our annuity hybrids is that they could go up to age 80, 85, or 87. You know, a lot of times people will think that, oh gosh, you know, I missed the boat on long-term care insurance because I'm too old in the process. And I'm here to tell you that up to 87 years old, you can find some solutions. They do shrink the older you get, but there are some solutions as you age. And finally, there is a solution where you can take permanent life insurance. You can take a whole life insurance plan or a universal life plan, and you can say to the company, hey, I want to buy a rider to draw down my death benefit for long-term care. So in each case, in all 4 cases, you trigger the benefits by the inability to do 2 of 6 ADLs, or you have a severe cognitive impairment. And as you can see, we're looking at 4 different options that may work separately. So let's look at the standalone long-term care. That's the traditional, that's pure insurance. So you would choose like a daily or a monthly benefit. You might choose a 2, 3, 4, or 5-year plan. Now, I would say to you out there, excuse me, when it comes to long-term care needs, most men will go about 3 to 4 years. Women will go 4 or 5 years if they need it in the process. Most long-term care plans will have an inflation option so that you will grow your benefits over time. All long-term care plans are going to have an elimination period. Elimination period is no more than a deductible. And for long-term care, your deductible is usually about 90 days. Elimination period is done in a number of days so that if you can't do your ADLs or you have a cognitive impairment, and the insurance company says, okay, you're approved, then usually for the first 90 days, you're out of pocket. And then the last thing I'll say, excuse me, is this plan has recent stability, meaning the rates have been full. Excuse me. Our second option is the linked benefit life hybrid. So we're combining life insurance and long-term care. You might take a current life insurance plan you have and move it into this plan. You cost share your long-term care, but it's an asset and you can retain control of it. What's interesting is you also can buy a lifetime plan with this, saying, instead of buying 3, 4, or 5 years, hey, I want my plan to last as long as I live. And you may say, I want a company that pays my benefit as an indemnity, as opposed to reimbursing my expenses. I want income tax-free cash every month in order to buy the services that I want to buy. Maybe I want my neighbors or my children to help look in on me, and I want the ability to do so. So there's some real flexibility with that type of plan. So let me show you how this works. This is an example of a 60-year-old male who made a deposit of $100,000 into one of these linked benefit life hybrid plans. And by the time he was 80, he had now $900,000 of long-term care benefits at $9,100 a month. And he had a $100,000 death benefit to go along with the plan. Doesn't need the long-term care. The $100,000 death benefit pays back to his estate what he put into it. By the way, these are benefits at age 80. The inflation option on this particular plan still grows. So if he was at 85, 90, 95, the benefits would still have grown in the process. So let me show you how this works. At 80, if the client couldn't do their ADLs or had a severe cognitive impairment, then he would start collecting $9,100 a month. But they're going to draw down the death benefit first. Well, in this case, plan was funded with $100,000 deposits. So he's kind of getting his money back early on. So what I like to point out to people is this is kind of a high deductible long-term care plan because early on you're getting your money back. However, if you have a need that goes past that initial 6, 7, 8, 9 months, you have an additional $800,000 at age 80 and more if you are older in the process to create long-term care. So you're in a situation where you fund it and you're guaranteed either your estate gets the death benefit come back because you didn't use it or used very little of it, or you have extensive income tax-free long-term care benefits to offset your cost. A very effective and in today's world, a very popular solution to come for long-term care. You can also do the same thing with annuities. It's an annuity with a long-term care rider. The interesting thing about the annuity hybrid is you're able to add your spouse to it. So a lot of times we'll run into folks who have a non-qualified annuity, not necessarily going to use it for income, but they thought it was a good investment at the time. You can move it into a newer annuity with long-term care benefits, cover your spouse day one, and get 3 or 4 times the deposit to help offset future long-term care costs. You still, in this case, as the previous case, control your asset. So in this case, if you never need it, the annuity passes on to your heirs like any other annuity. So the final option that we have today, which is usually done for younger folks in the process, is if you say to an insurance company, I need life insurance, but I'd also like that additional flexibility of using my death benefit for long-term care should I need it. Maybe you have a situation where you buy a $200,000 life insurance policy with a 4% rider. So 4% of $200,000 is $8,000. You can't do your ADLs or you have a cognitive impairment, then you start having $8,000 out of that death benefit every month to offset or pay for your long-term care costs. So let's think about it for a second. I've gone through fairly quickly 4 separate ways to offset your long-term care costs. Your traditional plan, which is just, I tell people a lot, it's like your homeowner's insurance or your automobile insurance. You hope you never have a claim, but if you do, you're really glad you got those benefits there to offset the cost. You pay an annual premium or a monthly premium or a quarterly premium, but you pay it every year. If you need it, it's there for you. If you don't, there's no real residual benefit. But we do have the life hybrid that provides the residual benefit of life insurance or long-term care. We have the annuity hybrid that gives you annuity and that those annuity deposits still grow over a period of time, but 3 or 4 times the amount should you need long-term care. And then we allow a rider to dip into your death benefit should you need long-term care and you have that additional flexibility in the process. So before we turn it back over to questions, I'll just kind of recap where we are today. So we're living longer. We have a larger population of need in the United States when it comes to long-term care. In fact, our country has not ever seen a generation like the baby boom generation. they will have a higher level and a larger need when it comes to long-term care. And because we live in that demand economy, you can bet long-term care prices are going to go up at a more accelerated um, period in the future. We have Medicare and Medicaid. Medicare provides a limited 100-day skilled care benefit. Medicaid, you have to qualify for, you have to spend your assets down, you have to agree to income limits, and you basically turn your care over to the state because they tell you what kind of care you're going to get. We have 4 separate long-term care plans out there that the only way that you would find out what might make sense for you is to set some time with your advisor to say, hey, I want to explore my options in the process and see how that fits in with long-term care. You have the traditional plan, the life hybrid, the annuity hybrid, and the rider to life insurance. So I would encourage all of you out there, again, remember, it's about a plan. It's your plan. It's your plan with your family. But think about how a long-term care event might impact you, your stream of income in retirement, your assets in retirement, and more important, your family. I want to thank you for joining us today, and I'm going to turn it back over to Ken.
All right. Thank you so much, Brian. We did have a number of questions come in. Brian, if you want to either exit the presentation or go to the next slide. There you go. First question we had come in regarding tax advantages. They asked, are there tax advantages for credit unions, aka for nonprofit organizations, similar to how there are for sole proprietorships, LLCs, etc.?
There is.
Wonderful. Next question is about let's see, cognitive impairment. So this says, how severe does cognitive impairment need to be to qualify for LTC insurance benefits? And then there was a couple other questions on this topic regarding Alzheimer's specifically, asking if that's an issue, and then dementia as well.
Certainly both Alzheimer's and dementia would be a severe cognitive impairment in the process. What the insurance companies will do when you begin to have an issue with cognitive impairment, they will look at your ADLs. They'll also look at your environment. They'll look at, can you still drive a car? Can you keep a checkbook? Do you pay your bills? Are you in charge of your household? And ultimately, there are a couple of tests out there, cognitive tests out there, that will measure your acuity in the process. And at some point in time, they'll take a look at that. What'll happen when someone has that cognitive impairment, at some point in time, not only will they go to their primary care physician, but they'll go to a specialist. And a lot of times they'll take tests to gain how much of an impact a dementia or Alzheimer has had in your ability to retain knowledge in the process, and that'll be figured in the claim process.
Awesome. Next question is, can a couple buy a plan to cover long-term care for the surviving partner?
Yes, they can. And that's it's interesting. That's a great question on whoever asked it out there. And the reason that's a great question is I would say to you that the most important person to cover is the surviving spouse, not the first spouse who needs a need. Because when there's 2 of you under the roof, one spouse tends to pitch in with the other one. But when there's only one spouse under the roof, you really rely on insurance plan benefits because that's where the multitude of your care is going to come out of the process. And so there are 2 companies out there today that have joint plans. So both spouses are on the plan, but more companies are recognizing that that is a need to the marketplace, and they're coming to the marketplace with those plans.
Then we have a couple questions on health conditions. So I guess say pre-existing conditions. What if you have health conditions? Can you still apply for life insurance with long-term care?
You can. And so So one of the things with our particular organization, Ash Brokerage, we actually have a long-term care underwriter on staff. So if you are looking for long-term care coverage, we have a process to what we call pre-screen you. And by that, you fill out about a 15-minute medical survey. You push a button, it goes directly to our underwriter. No one else sees your answers. And what she does is she goes out to every type of long-term care product company today and says, I have a person this age, this height and weight, taking these medications. How would you react to them? So whether it's the traditional plan, the life hybrid, the annuity hybrid, or life insurance, the rider, we're able to narrow down choices before you get anywhere close to an application. And by the way, whether you deal with us or any other organization, we strongly believe in that. You want to make sure that you can qualify for your coverage before you go through any type of application process.
Makes sense. Broad question here, but someone said, how much does it cost?
That is the best question. Of course you want to know in the process. So let me tell you the fact. To begin with, you got to sit down with your advisor and look at your particular situation. But I can tell you what impacts the cost. Your age is going to impact your cost. The type of plan is going to impact your cost. For example, the pure insurance is going to be your cheapest plan that you pay a premium every year. If you're a male, you probably are going to pay $2,500 a year, depending on your age, which has a big impact on your price. If you're female, you're probably going to pay $3,000 to $3,500 a year, depending on your age. Female pricing is much more expensive than male pricing when it comes to long-term care. Why? Because females claim more often and they claim for a longer period of time. If you're looking at some of the hybrids, the life hybrid, a lot of people, depending on your age, will look at a life hybrid at $5,000 a month, $7,000, no, excuse me, not a month, a year in premium, but maybe over a 10-year period of time. So at the end of 10 years, you're done paying premiums for the rest of your life. Now, the annuity hybrid is a lump sum. It's a deposit. It's not a 5 pay, a 10 pay, or a 20 pay in the process. And usually we see a deposit of 50, 75, 100, in some cases higher than that. But that gives you a general sense of what the costs were in the process.
All right. And the final question we have is, what age do people usually start talking about long-term care?
Early to mid 50s. And the reason we say that is most people that I've dealt with over the years, at about that age, there's a balance, right? You can see your parents and your grandparents aging. Children are high school or college level, but you can see the day that they're going to be out of school. And so now you're beginning to think, okay, how do I round out my retirement plan? What pieces need to go into it? And so I see most people will begin to start looking at it 50 to 55 when it comes to long-term care. Occasionally I get people in the 40s, but that's only if you've experienced a really horrendous event with a family member, and maybe it's an Alzheimer's, dementia, where it's an 8, 10, 12, 15-year need for a family member. So it puts you on notice pretty quickly. But again, as I mentioned a little bit earlier, solutions go up to 87. So I would say to everybody out there, if you're really interested, make sure you set some time and find out what you might be able to qualify for.
Excellent. Well, thank you so much, Brian. Really appreciate you coming on today and educating us. If anyone does have any additional questions that came up, you can reply to any of the emails that were sent out about this webinar. That email address is plantoday@srpretire.com. Our next scheduled webinar is going to be on Tuesday, July 15th, 1 p.m. Eastern, and that's going to be on Social Security. So with that, we'll wrap up. Thank you so much, everyone, for attending, and have a great week.